We are getting hit with an economic shift that's going to make a bunch of millionaires and poor people very quickly. And it's going to change the economic climate that we've been dealing with for the past few years. In the simplest terms, it's just this number being higher than this number. The top number is the 10-year Treasury yield, and the bottom number is the 2-year Treasury. And we are going to see oceans of money, trillions of dollars, moving into different kinds of asset classes because of this change. That is such a big deal because sometimes when that happens, the US faces a recession. If you want to know more about it, you should look up the yield curve inversion and what happens after it uninverts. On top of all that, the Federal Reserve said that we are most likely getting rate cuts this September. We're going to find out around September 17th or the 18th, and here's why it's a big deal. A lot of the time when the Federal Reserve makes a rate cut, we see a nice stock market rally, but then within 12 months, we get a recession. Then there is the SOM rule, which has been triggered, and it says we are facing a recession sometime in the near future. With all of these three things happening at the same time, a lot of finance bros are convinced we are gonna face a recession. So some people are taking short positions, or they're investing in assets that traditionally do well during recessions. Other people just hold on to a bunch of cash and they wait for their favorite assets to drop significantly in price so they could get things on the cheap. But there are some people like myself who don't think that there's enough evidence to suggest we're inevitably facing a recession. I mentioned the 10-year Treasury yield finally going higher than the 2 years as a potential recession indicator, but that indicator failed in 1966 and 1998. And the interest rate cuts failed as a recession indicator in 1995 and 1998. Both times, interest rates were cut and there was no recession within a year or even 2 years. And while the SOM rule has been effective at predicting recession since 1978, the creator of the SOM rule, Claudia Sahm, has said this time it really could be different. So we actually don't know if there is going to be a recession or if we're in one now. So those investors who made really risky bets thinking everything is going to crash may lose money if we don't fall into one. There's an economist on this app, his name is Christopher Clarke, who made a post saying we may be in a recession, we may not be in one. We won't know until enough data comes out. And I am 100% in this man's court of thinking. People don't take into consideration that the United States economy is very agile and it is constantly evolving. So indicators that may have been 100% effective 30 years ago may not be so right now. But there are some things we can be sure of with this change in the financial climate. When the 2-year Treasury yield is lower than the 10-year, it's generally accepted that people think the economy is going to do better in the long term than the short term. And that's how it normally is. And the Fed lowering interest rates means that it's cheaper for banks and other financial institutions to make loans, which means money flows more freely in the economy. That's why generally the stock market does well after interest rates have been cut. But long term, things are still up in the air. I find Warren Buffett's actions over the past few years to be quite intriguing. While still holding on to a bunch of his equities that he trusts, he is also sitting on about $277 billion in just cash. He also recently acquired 8 different stocks. So he still has a wide portfolio of equities, but he's also sitting on a bunch of money just in case prices go down and he thinks something is oversold. What do you think about all this? I am the Geo Hussar, and let me know what your leading economic indicators are. Thanks for watching.